all of us are logical in the same way. The right thing for us to do is actually pretty much the same for all of us. And yet the reasons we don't do that right thing, the reason we sit in cash, can actually be very different person by person by person. I started out as a very traditional economist, and economics is all about what we should do if we're rational individuals. And I was very interested in that because clearly we're not all rational individuals all the time.
We want clarity, and we desire clarity over chance. And so this may explain why people may hold onto their cash instead of investing. I'm the head of psychology and behavioral science at Dynamic Planner, and through research, I apply behavioral science into the software that we provide for financial advisors.
Most investors do not base their investment decisions based on rational fundamentals, but much more on sentiments, fads, and other psychological biases. I'm responsible for Capital Learning, and Capital Learning is a new team within Capital Group, really with the aim of raising the knowledge of our distributors so they can have more successful client conversations. When uncertainty hits, investors have the tendency to move their money into cash. And we've seen that historically, but too much cash can also jeopardize the investor's long-term goals.
The yields on a savings account are going to be more typically when interest rates are higher, which will be when inflation rates are higher. Those yields are slightly spurious because, yes, you're getting paid more for keeping your cash in the account, but it's at the same time as your cash is becoming less valuable because of inflation.
People can feel compelled to hold onto their cash and wait for more appropriate times to invest. This is because they're attempting to time the market.
Recency bias is the tendency for investors to use information that come to mind quickly and easily when taking investment decisions. 2022 was extraordinary because it was one of the few years when both bonds and equities sold off. Usually bonds and equities tend to move in opposite direction. In other words, they have a low or negative correlation. But in 2022, they were very positively correlated, and global equities lost 18%, whereas global bond lost 16%. So this year has been really lingering on the mind of investors.
There's a quote by Daniel Kahneman, who's the father of behavioral economics. Nothing in life is as important as you think it is while you're thinking about it. The mere fact that we are thinking about something means that in our decision making at that moment, we're giving it too much weight.
How much of a range do you see on that emotional scale in attitudes towards risk?
It's absolutely huge. I mean, the emotions that steer our decisions in investing, the two that everyone comes to are, in fact, fear and greed. And sometimes they pull us into things in great excitement. Sometimes they pull us back. But sometimes it's more subtle things. It's sort of procrastination. It's discomfort, inertia.
Research shows that risk tolerance is very domain specific. So my attitude when it comes to driving and how I may speed, or if I'm at the theme park and I enjoy going on the rides and feeling the ups and downs of the roller coaster, may be very different to my attitude when it comes to investing and experiencing the ups and downs along my investment journey.
And a scale that we find very important is composure. If you are a high composure individual, you are simply more likely to be able to keep your eye on the long term. Whereas if you're a very low composure individual, you are emotionally feeling every bump in the road. Every news headline, every dip in your portfolio is going to cause an emotional response and an emotional reaction. Sometimes that might be euphoria. You go, wow, I'm a genius investor. Look what I did yesterday. It's gone up. Sometimes it will be terror. But we all face these.
Research shows that those who have higher levels of financial self-efficacy have greater control over their long-term finances. They are less stressed when it comes to their financial situation. They're more optimistic about the future of their investments. And when things don't go according to plan, they're better able to manage their emotions during those difficult periods.
Whatever era we've grown up in sets a background risk level. People who were born and grew up in the Great Depression in the 1930s US, that cohort, that age of people throughout the rest of their lives were less likely to invest in stocks and shares.
Cash seems less risky to people who have seen stock markets crash. How do you square that circle?
Because all of those crashes are things that evolved over a period of months to a few years. So yes, it is risky. Yes, you can lose money. But the big danger there is not the crash. The big danger is selling at the bottom of the crash. It's not the fall that kills you, it's the landing.
It's natural that when markets are fluctuating and things are not going to plan, people are fearful.
That's how we survived as a human race. Being able to steer clear of saber-toothed tigers on the African savannah. In many ways, it doesn't matter what environment we're in. The human mind will always think up excuses not to get invested because it's just the more naturally comfortable thing to sit in cash. All it does is it provides a different menu of excuses.
How much is this lost opportunity costing everyone?
The average investor, because of their need to make decisions that feel comfortable at the time, it's fair to say probably gives up about 3% of investment returns on their whole investable wealth per year, every year, over time. I mean, there's a caveat there, of course. If you do it catastrophically wrong, if you get in March 2008 and you sell in March 2009, equity markets dropped about 50% in that 12-month period. So, action can cost you more, but most of the time, inaction is the more costly thing.
The market expects that we are at an inflection point, right? Nobody knows exactly when central banks will start decreasing interest rate. But if you look at the Fed fund futures, for example, it is expected that, for example, in the US, interest rate will come down. Now, if you believe that's true, then that might have serious ramifications for your yield on cash.
The challenge for individuals who are holding onto their cash is understanding how willing they are to take risk and how much risk they can afford to take. So for these individuals, they need to learn to focus on what they can control.
Ideally, investors ignore the news and ignore the noise, right? Typically, media can report that the stock market is up one day and the next day they might report that the stock market is down. But investing is something you do for the long term.
When people make impulsive decisions because of fear, they can lose out. When people try to time the market because they want to hold onto the cash and wait for an appropriate time, they're already missing out on investment opportunities.
It makes people feel comfortable that they've got lots of money in the bank account. They don't have to worry about things as much. And I can see that has a value. It has a very real value. But equally, what you're not doing is you are not providing your capital to the world to be put to productive uses. You're squirreling, right? It's not growing. It's not doing anything for you in the future. It's not doing anything for anyone else either, because the world needs capital to be able to grow.
Did you just do a quick scan of the room and think, well, I'm going to appeal to their sense of social responsibility?
Yeah. Maybe you want to leave some money to a child or a grandchild or a charity or something. I think there's always a reason to be productive.
We sometimes have a strong distance and we're not able to connect with our future self. And so decisions that I make today are about me and are about my present situation, forgetting about my future self and future rewards that may benefit me.
Put your money in, diversify, leave it alone. Any of us can do that. And if you do those three things, you will do better than 80 to 90% of investors out there.